Well, my model asset allocation, assuming that interest rates come down and come down quite rapidly, that economies are slowing in the short term, but will then recover later in the year, my model asset allocation is now seeking more risk. So I have zero cash. So I have reduced the cash position. I have a maximum allocation to investment grade credit around the world. And that is, I'm using investment grade credit as my defensive fixed income asset. I prefer it to government bonds where I'm slightly underweight. So investment grade credit, I'm at the maximum allocation that I allow myself. And particularly within investment grade, I favor emerging markets. I'm also overweight high yield, which I think could be a little bit volatile in the short term. But as the year progresses, I think the returns on high yield will be reasonable. The same applies to bank loans. So I'm overweight both high yield and bank loans. I'm also now more, I guess, embracing risk. I'm overweight real estate, which clearly has fundamental problems, but I think a lot is already in the price. And as interest rates come down, I would expect real estate assets to benefit from that decline in rates. Elsewhere, I'm underweight equities, but that is largely because I think the US market is very expensive. And the US is a big part of the global index. So if I'm going to be underweight US equities, I'm pretty much forced to be underweight global equities. But within equities, I prefer Europe. I prefer emerging markets. I've already mentioned that I like China. And finally, commodities. I think in a slowing global economy in the short term, I think industrial commodity prices will come down. So I'm zero allocated to commodities, but I would expect the price performance to improve towards the end of 2024. So favoring credit, favoring real estate, bank loans, and from a regional perspective, favoring European and emerging market assets.
Many investors, both institutional and small retail investors, do not like Europe, do not like the outlook, despite what was happening in 23. For instance, stock markets performed very well. You said that you do like Europe. So what in particular do you like?
I think there are two things. First of all, there is a price for everything. So, you know, even when the fundamentals are bad, if the price is low enough, then that can still be a good investment. And in fact, can be a better investment than something that you really like, but where the price is very high. So I think, you know, European equity prices are a lot cheaper than in the US, cheaper than somewhere like India. But the other thing for Europe that I think is going to be attractive as interest rates come down and as economies recover is that the European economy is in a worse place than the United States. So it has more to benefit, more to gain from the upswing and the reduction in interest rates. Also, the European stock market has many more what we would call value companies, as opposed to the growth stocks in the US. And those value companies, you know, they become cheap. People ignore them and then they deliver good returns in the future. And I think as interest rates come down, we should be seeking out those companies that perhaps have been the most under pressure as a result of higher interest rates. So we're looking for where the relief is going to be the greatest. And I would expect yield curves to steepen. Banks tend to do better when yield curves steepen. Europe has got a lot of banks. Real estate, I think, will benefit. But Europe has a lot of these kind of values. We talk about, if we want to be pejorative, we talk about when economies recover and equity cycles start, we talk about a dash for trash. And Europe has more of that trash, to use a slang term, than, say, the United States does. So I would expect Europe to benefit from that. It's cheap and it's got the sort of companies that will benefit more from the recovery.